Every time I try and record a video, right, I mess up. Either my webcam stays up like this, right? It's not actually like this. It's up like this, and I just record the whole video not knowing that, or I mess up somewhere, some way else, and I'm sick as fuck too. I just recorded a 30-minute long video, and I have no footage for it. I have nothing to show for it, so now I gotta record it again. That's the game. Today we're going to be talking about how to use our 4 or 5 confluences that we've learned over the past week or two and how to actually put them all together. I've shown you guys how to use these confluences by themselves. Even the last 2 videos were about fair value gaps and liquidity. Literally, you can probably just trade off of that alone. Okay? But for everyone else that are getting the unlisted videos as well, you guys have seen the ins and outs from everything that I've taught you guys. So today we're going to be learning about how to use these confluences all together. So let's get right into this because I'm sick and tired of recording this video. How do I... White Iver Sun. Alright. So we're going to go ahead and zoom this out. Alright, let's get into this. So how to use your confluences and how to know which trades are more higher probable. Now, as traders, we want to look for the most probable trades. Okay. Where's 930 open? It's right here. Okay. So on the 15-minute here, we can see that we are very bearish. Okay. Very bearish. Even if we won the 4-hour, you can see very bearish. Now, for the first trade that I'm gonna be teaching you guys, that I'm gonna be looking at right here, okay, is not the 930 open. This happened later on in the day, and this is kind of something that I would have taken. If we go on the 4-hour, we can see how, we can see how we're in a 4-hour fair value gap. Okay, we made a lower low, and then we came up into this 4-hour fair value gap. Now it's already happening right now. Price is rejecting. How do we know it's rejecting? Go in 1 minute. It's disrespecting bullish order flow and respecting bearish order flow. Now let's go even more in depth. So we're in a 1 hour, we're in a 4-hour. We go on the 1-hour here. We can see how we had these highs to the left of us. Okay. We had this high right here, as well as this high right here. Okay. Now Nasdaq didn't sweep out this high. It came close to it, but it didn't sweep it. If you go on ES here, ES swept out those 2 highs, same highs. ES already swept those out. Okay. And we're in a 4-hour. So those are 2 confluences already met. Go on the 1 minute. We can see. Okay, inverse fair value gap right here. Bang, bang. Breakup structure already happened. We had to close above previous lows, internal. Okay. And then we also had this 1 minute fair value gap. Now, yes, we did have an inverse right here, guys. But remember, we had SMT above us, and we are bouncing out of a 4-hour. Okay. Now you could have taken this either this tap of the fair value gap above us, guys. You don't have to take the inverse. You can also take the tap. If you know you are bearish or bullish, you can take the taps of the fair value gaps. Because why wouldn't it bounce off of it if you know the trend? That's why market structure is so important. Now, we had an inverse of this fair value gap. We came all the way down here. You could have also taken the inverse of this fair value gap right here. Whichever one would have worked. Either entry up here and then stops at the high like always, targeting internal liquidity or external liquidity, doesn't matter. Or you could have taken the inverse, which is down here. Now your stop size would have been a bit bigger. Would have been 60 points. But if we fib out this entire range, guys, when you're taking a long, you wanna. So let's say you go to Walmart and you buy something, right? You're looking for the. Oh my god, my nose. Hold on. You're looking for the best price, right? For the most discounts. Same thing in trading. When you're looking for a short, you want to short everything above 50% would be the premium. Everything below 50% is a discount. Okay? So let's draw this out for you guys. So let's say we have a stock right here. Okay. We have a stock right here. And we fib this out from this low to this high. So this is the range that the Fibonacci is giving us. Now, this is going to be 50% right here. This line represents 50%. Everything above 50% is a premium. Alright? Everything below 50% is a discount. Now, do you want to buy something that's in a premium? No. Do you want to buy something that's in a discount? Yes. Do you want to short something that's in a discount? No. Do you want to short something that's in a premium? Yes. Why? Shorting in a premium will give us the best risk to reward and will also give us a higher probable trade. If we long something in a discount, this also gives us a higher probable trade. If we short something in a discount, that's not going to be probable because it's already discounted. You see how that works? So if we fib this out, same exact, just like I said in the example, fib out low to high. This is 50%. Alright. Let me actually highlight the line so you guys can properly see this. Bang. Alright. This yellow line represents 50%. Everything above this yellow line is a premium. Everything below the yellow line is a discount. Okay. Now, see here. Price tapped 50% and we had a reaction out of it. Was this a good reaction? Yes. We tapped this fair value gap, reaction out of it, inversing this fair value gap. We inverse this fair value gap? Yes, we did. Why? Price probably had another draw on liquidity or something it had to do for us to come lower. We probably inverse this fair value gap just to tap this fair value gap. That's how the markets are. It moves nonsensical. These markets don't make sense. Just like life. Just like everything else. Just like how black holes work. It's all nonsensical. It doesn't make sense. Okay. But our job is just to react off of these. Not to make things make sense. Just to react off of these. Alright? Off of these price movements. Now, you could have taken this fair value gap and just shorted this. This is in our premium. It's a fair value gap in our premium while we are bearish. Okay. So let's write down the list of confluences already met. So we had SMT with ES. Okay? We had SMT with ES. We tapped a 4-hour above us. We tapped a 4-hour above us. And we are bearish overall. Okay, we are bearish overall. We had a 1 minute inverse. Okay. And we had a 1 minute break of structure. Now let's scale out on the 5 minute because I also want to see. Okay, no. 3 minute. We had a 3 minute inverse as well. Oh, okay, that's why. If you look at the 3 minute, guys, bang. We had a 3 minute fair value gap that got inversed. We got an inverse. Okay, we got this inverse. Okay. Price came down, rebalanced right after. This is why I love a 3 minute, because it shows you things that you wouldn't see before. And it's a lot clearer. We had a 3 minute right here as well. The price never closed above it. Never closed above it. So, we also had a 3 minute inverse. Okay. Every time you're about to take a trade, write everything down like this. If you don't see inverse, if you don't see break of structure, if you don't see SMT, if you don't see 4 hour, if you don't see 1 hour, you're doing something wrong. You're doing something wrong. Okay? Now this would have been a trade that would have played out perfectly. Perfectly. Okay. It's on the 15th minute here. And let's look for a long. Okay. How could you have been able to catch this long in the morning? Market open, swept everything out. Could have taken a short, but it's a bit choppy. I wouldn't have recommended that. I would have waited, because right here, all we're doing is we're stacking up highs. While price is going lower, I want you guys to have it in the back of your mind. Okay, is price taking out these highs that's leaving it behind, or is it just leaving them? If it leaves them like this, guys, the chances of it going up to take them all out is higher probable. Okay. Now, I don't recommend longing this market, to be honest, but for the sake of this, we're going to go on the 4 hour. See where we're at. We're probably going to come back down just to sweep this out, to be honest. Yes. Yeah. We're going to come back down. This is going to be a really bearish market. I wouldn't recommend longing this, but nonetheless, I'm going to still teach you guys how to trade this. So, let's say we had SMT here. Most perfect world. We had SMT here. Either that or no SMT. You could have taken this 1 minute inverse. I would have taken this. Why? Because it's setting up for the perfect market maker buy model. Okay. We had okay, right here. We had a tight 5 minute right here. Tight 5 minute for value gap right here. Right here. Bang, bang. We respected that. Okay. We disrespected that fair value gap, that bearish fair value gap. We came down and we made a lower low. And we also made another lower low on the 1 minute. Lower low, lower low, lower low. 1 minute fair value gap got inversed. You could have taken this and targeted the highs that we left behind. All of this. Whenever price is doing something, it's also doing something else. Notice right here, we went lower, but it also created us liquidity for us to take out. Could have taken this. One hour fair value gap. Only 1 minute. 1 hour fair value gap. Break of structure. Okay. And we also got our inverse fair value gap down here. Right here. Now you could have either taken the inverse fair value gap or taken it up here. This is a kind of high trade in my opinion. Like really high trade. But it's still in the discount, I think. Yeah, it is. Yeah, you could have either taken the closure above the high, or you could have taken it just off of the fair value gap alone. Why could you have taken it off the fair value gap alone? Because, guys, go on the 5 minute here, or even another higher time frame. I'm too lazy to check it, to be honest. 1 hour, fine, fuck it. Clear. It's clear that we closed above all of these highs. Closure above the high. We got to close above a high. We're creating lower lows. And we're also in a 1 hour fair value gap. Okay. We left stacked highs up here. Now, if we left a single wick that just took everything out, I wouldn't have taken this. I'd be like, okay, we're probably just going to plummet lower. But since we left stacked highs up here, this creates a higher probable trade. It's coming out of a 1 hour fair value gap. We got an inverse fair value gap. And we also got a 1 hour break of structures to the upside. You could have taken the inverse fair value gap, targeted external or internal draws on liquidity, and you would have TP'd easily. Okay? That's how simple this shit is. You don't need no extra stuff. Okay? All it is good stop loss placement, good understanding of the markets, good understanding of where the markets want to go, good understanding of how market structure is. All right? Technical analysis doesn't need to be really complicated. Simple as fuck. The more simple it is, the cleaner your chart's going to be, the more easier it is to read. That's all for this video. I hope you guys learned a bunch, dropped some gems. And yeah, I dropped some gems in the video for you guys, and that's all I gotta do. Write down your notes. Have an amazing rest of your weekend. This is Friday today. I'm probably gonna upload this today. For my students, I know I haven't been super consistent with my videos, guys. I'm so sorry. For everyone else, keep watching, bro. Keep watching the YouTube videos. Keep at it. Do you.